Hey guys, how's it going and thanks for coming. I'm Nick, and in this video we're going over the mortgage forbearance crisis that we're going into right now. So we're going to see at what cost a mortgage forbearance is for you. So we're looking at the pros and cons of going into forbearance for your mortgage. That's definitely a big thing right now. Looking at your options, and then is that going to lead into something larger? So we got to know exactly what's going on, especially for possible new home buyers out there. I'm in that camp, waiting patiently in the shadows, so let's talk about it. So unless you've been living under a rock for the past month, we know that the CARES Act was passed and that it's trying to help people with their mortgage payments. So you are able to go into forbearance, but what is forbearance? So let's start there. What you should know about mortgage forbearance. Mortgage forbearance can help you deal with a temporary financial setback. You'll be able to skip or make reduced payments for a predetermined period of time, but interest still accrues. So we will be talking about if we should be going into this or not. However, what this mortgage forbearance is, like we just read, that you can delay these payments. Deferment is up to 180 days. So I'm hearing some people are getting like 3 months, some are getting up to 6 months, and you don't have to pay during that time. But what happens after that? So luckily there are no fees or penalties to do that, but once you get at the end of that period, then you could possibly file for other options. One example would be to extend it even further. I read up to another 180 days. Now, quick side note, not only for homeowners but also renters, I heard that evictions and foreclosures are actually delayed by 60 days starting from March 18th. So it is helping some renters out there as well. So we can look at the pros and cons of this situation because there are options that we could look at. So you would obviously look at this if your income or your job was affected by what's going on right now. A lot of people are unemployed, furloughed, lack of hours or lack of pay. So this is definitely why it's so popular right now. But is it really worth it? So hopefully you could see this green marker, but obviously the first pro is that you can't pay your mortgage, so you go into this option. But I stress the word can't because there are a lot of different cons that we have to look at that you might not even think of. So I will say, if you do choose this option, it does give you temporary release, but it's really only for the short term. Now, one huge con, which a lot of people would definitely question, is how could it affect your credit score? Well, over here at LendingTree, the effect of mortgage forbearance on your credit. Under the CARES Act, there should be no negative impact on a borrower's credit score for payments missed during an approved forbearance. But don't stop making mortgage payments until you have a written forbearance agreement in place. Otherwise, the servicer will report late payments to the credit bureaus, which will hurt your credit scores. So we're hearing that in theory, it shouldn't affect your credit scores. However, is that actually true? So a couple other sources with this one. This is from NerdWallet. Will mortgage forbearance affect my credit? Unless your lender has agreed not to report it, your forbearance will be reported to the credit bureaus. But mortgage forbearance is less damaging to your credit score than a missed payment and helps you avoid foreclosure. So there definitely is a fact that it could be a pro if you go with this option. It is better than a missed payment because you're going into forbearance, you know you're struggling with this, so that could help you in a better situation. However, this might just be a theory and it still might go through the credit bureaus and it could hit your credit. At the same time, I heard from another source that it hurt them as much as like 75 points on their credit score. So that's like a whole rating dropped. You know, you could be a solid borrower with the 700 credit score and then you might not get knocked down to 600. So would you be able to negotiate that? Possibly. It's really, a lot of things are up in the air at this point, but understand, you know, they might say it might not affect you, but it certainly can. So keep that open. So this is really made for if you literally cannot pay your mortgage, this is the option that you have. However, if you're able to, a lot of sources are saying that you should continue paying that, especially because of the next con that we have to look at is the options after this forbearance period. What can you do once you have to continue? So let's talk about the options after you actually go into forbearance. You know, you have it for maybe 3 months, maybe up to 6 months. Now, what do you have to do after those? So the options here, that's a big O, is that the first option that you might have to do is a lump sum payment. So for example, you know, you skipped 3 months. So on the 4th month, what you didn't pay, you owe all of that as a lump sum. So obviously, if people are struggling to pay per month, what do you think? You simply can't pay for a lump sum after those months. So that option is almost garbage. Now, if for some reason you're able to, you know, by all means, you could probably do that, but that's why that could definitely be seen as a con. The next option would be a repayment plan. So like we said before, you are able to extend it up to maybe another 180 days. So it kind of helps you along in the short term, but then it just brings you back into the same situation. So it really doesn't help you too much. So again, that's another con. Now another one a lot of people are talking about is a loan modification. So your whole entire, the most common loan is like a 30-year loan. So they would adjust or modify your existing loan. Now, the terms of the specific loan modification, you really have to see if it works for you. This is from Lending Tree again. Their loan modification is telling us that lenders may allow you to change the original terms of your loan permanently with a mortgage modification. Options may include extending the term of your loan, lowering your rate, or reducing your principal balance. You may not be eligible for a loan modification unless you're 60 days or more behind on your mortgage payments. So then some other alternatives they're saying are mortgage refinances. Obviously, you could always try to sell your home. There's a short sale. So if it does make sense, then a loan modification could help you out. For example, if they just add more days or more months to the end of the loan, it just basically extends your loan. Given this might bring on additional costs, maybe if you have to refinance or modification of loan or anything like that, but I heard that some people are worrying about this situation, and I want to write out the diagram for you. So let's say you have a 30-year loan, and let's say you have a mortgage of $250,000. Well, what if they're not extending the loan for another, I don't know, let's say you extended it for 6 months. What if they're not doing that and you still owe that money instead of 30 years? Now it's, let's say you knocked off 6 months and you had to extend it. So let's say it's now 29 years of the loan and you still owe the $250. If that happens, you owe the same amount in less time. That would only mean that your payments would increase. So that's why you have to be aware of the terms of the actual modification, because you could definitely be paying more. And I almost forgot to mention, a quick side note is your escrow account. When you have a property, you have a house, there's money on the side to pay for your principal, interest, taxes, and insurance. Well, if we're looking at the principal, we know what's going on with the principal that's being delayed with forbearance. Interest, you don't have to pay that now, you will have to pay that in the future. But what's going on with taxes and insurance? Well, now I'm reading that your escrow account is actually going to pay for the taxes and insurance, which is leaving the escrow account low, which would have to be filled back up at a later point. So that could cause possible future costs or future payments at some point as well. So I'm not really hearing a lot about that, and that's definitely something else that we would have to consider. So that's exactly why, if you're able to actually pay your mortgage right now, definitely pay it, because then you would have to go through these options, which could hurt you in the long term. We're hearing that around 6% of mortgages are actually going through this mortgage forbearance. So let's say if you do go through this mortgage forbearance, it helps you in the short term. You might have to extend it, because this is definitely turning into a larger situation than everyone was expecting. So you might have to extend that for another 6 months. So what happens, Like, something has to happen eventually. So what happens to the property? Would you have to possibly sell it because you can no longer afford maybe the payments? You can't have any other options. Maybe the loan modification hurts you. Maybe all the other options might end up hurting you. What happens to the actual property? The problem now is that the Federal Reserve is going through actions. You can see here, this is CNBC. Mortgage bankers warn Fed mortgage purchases unbalanced the market. The Mortgage Bankers Association warned that the housing market could face a large-scale disruption due to the actions by the Fed that were meant to help the mortgage market. The Fed bought $183 billion of purchases last week of mortgage-backed securities in an effort to drive down rates. So let's get into the Fed a little bit more if you're unaware, because they're printing a lot of money right now. I should probably put a little bit more because they're printing a lot of it. So what could the Fed do to possibly help? So one quick example, this went back to 2008, the last recession. The Fed did something very similar to bonds, like Treasury bonds. So they pumped a huge amount of money into bonds. They dropped those rates to basically try to stimulate buying and make sure liquidity is there. They're doing that again, basically with everything else, including mortgage-backed securities with houses. So just like in 2008, right now in 2020, these rates dropped and mortgage-backed securities rates are dropping just as well because they're just funneling so much into it. So this could be seen as helping people in case you did want to refinance a mortgage. It's keeping those rates low so you're able to do that. When you're able to refinance, you could possibly have a lower payment because the rate is lower. But there is a huge asterisk here, is there's a problem. Now in normal times, if you're familiar with risk and return, normally if there's a low risk, you get a low return. For example, look at your savings account or CDs right now. There's really no risk at that point, so the rates are very low. That's what the Fed has been doing with these mortgage-backed securities, keeping these rates low. However, in normal times, when there's high risk, there's a higher return. So if people do start going into foreclosures, people start struggling to have payments, that's a higher risk. And that's why the Fed is trying to keep rates low. However, if risk is seen as higher, then rates could definitely spike back up. That's exactly what the Fed does not want to happen. Heck, a lot of people don't want that to happen because if rates go up, guess what? You won't be able to refinance and save money. You won't be able to borrow at low rates anymore. And because these rates have been so low for so long, it has been inflating the housing market because people want to buy houses at these lower rates. So I don't want to go too much in detail of what could happen, but as the Fed continuously prints money to possibly help these people in these mortgages going through forbearances and struggling to pay with all this unemployment, what could that look like? Well, with all this money printing, there could be seen as inflation or even hyperinflation or stagflation. So we could see back in like the 1980s, rates were skyrocketing. Mortgages were maybe between 10 to 15%, and that's exactly what they're trying not to happen. However, it definitely is possible. We saw it in the 80s. So this could then cause possible disruptions in the real estate market like we saw with that one article before. So if these interest rates increase, that means people are less incentivized to buy houses because it costs more. So that means the price of real estate might go down. But at the same time, trying to keep things super simple, because it's really not super simple right now, is that with all this money in the system, that causes inflation like people are expecting. So instead of this situation, real estate might actually increase because it would take more dollars to pay for it. So the simple fact is, with all this money at this point, the typical cycle of basically everything is just so disrupted that no one could predict anything. So realizing that this might not be over, so if forbearance works for you because you literally cannot pay for it, then possibly go into it. However, if you can, and especially if you're able to save on the side, it might be a little difficult now, but since anything could happen, this is certainly not over. We have to prepare for the worst while hoping for the best. So that's why we went into if mortgage forbearance could be good or bad for you, and how this could possibly trigger something much larger for forbearances, for real estate, and overall the economy. So hopefully that helped you a little bit on your decision of if you should go into this. If you guys have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. What do you think could possibly happen in the near future? Because this was like going into a bigger picture scenario. A lot of people are expecting real estate to crash. I did just do another recent video if you should be buying real estate right now. If you're interested in looking into a little bit further into that, you could check that video out as well. Link in the description, especially with the Fed printing all that money. So let me know what you guys have to say. If this video helped you out, hit this video with a thumbs up to help other people's out as well. Don't forget to subscribe for more videos, and I'll see you guys in the next one.